Hi everyone. The company was signed to our group is called the Safety Godown Company. I will give you guys a short introduction of that company. The Safety Godown Limited is a Chinese company based in Hong Kong with a long history of nearly 60 years. The company is now managing business mainly in warehouse services and property investment. It is also one of very few warehouse providers to be listed in Hong Kong Stock Exchange. The Safety Godown Co. Limited has 2 warehouses in Hong Kong, and the total warehouse storage space is about 850,000 square feet. One of the warehouses is called Chinwas Godown, located in the Changwan cargo working area. It can provide conditions for both sea and land storage services. And another warehouse is called Godown Warehouse Number 4. It is close to Changchuan Container Terminal and Hong Kong International Airport, connecting with the major highways to mainland China. And I will gonna talk about the financial part of this company. Up to the end of March 2018, the total revenue about this company is about 135,000, and the net income is about 471,000, and the market cap is about 2,025,000, and all of these units are counted by 1,000 Hong Kong dollar.
In Resolution 5A, the company is asking for the power to issue and deal with additional shares without approval from the shareholders. The reason will be explained in the next slide. So in the past year, Safety Godown faced severe industry competition and also suffered through the decline of traditional warehousing and decreasing demand for traditional industrial products. The warehouse income decreased by 30%. Furthermore, the warehouse industry is experiencing a new trend, which is introducing automated operation. Therefore, the company is planning to make investments in order to upgrade software and facilities, as well as shifting from traditional industrial products to more profitable products. We can imply that they wrote Resolution 5A in order to finance for these investments.
As previously explained, the rationale behind Resolution 5A is likely to be related to financing investments at Safety Godown. In order to further evaluate this proposal and its potential impact on shareholder value, the company's stock price will now be further evaluated. Currently, Safety Godown shares trade at a value of 15 Hong Kong dollars per share, and a peer analysis based on PE and PB metrics shows relatively low values for Safety Godown, especially when compared to their peers. The company has a PE value of 4.31 and a PB value of 0.44. This can also be derived from the company balance sheet, where the book value of the equity far exceeds the market value of the equity. These measures imply that the stock is currently undervalued, meaning that the stocks would have to be issued at a relatively large discount, making it a very costly way of financing. Also, issuance of stocks sends a market signal that the stock could currently be overpriced, leading to an even lower share price. The pecking order theory suggests that the company should first attempt to finance from retained earnings and debt financing, and especially in this case where the stock is currently underpriced, equity financing should only be used as a last resort measure.
Looking at the stock price performance over the past 5 years, it had a rapid growth from 2014 to 2016, but dropped in May 2018, which seemed to be the industrial trend for its peers. To project future stock price, we rearranged the Gordon constant growth model to calculate the stock yield, defined as the discount rate investors use to compute the present value of expected future dividends, and it is equal to the dividend payment divided by the stock price plus the dividend growth rate. The stock price at August 10th was 15 Hong Kong dollars. The 2018 annual dividend payment is 56 cents, and we use the dividend growth rate as obtained from the FT, which would be 31.97%. The discount rate R, which can also be interpreted as the long-run expected return to buying and holding Safety Godown Company stock, is calculated to be 33.57%, and the one-year projected stock price with this expected return would be 20 Hong Kong dollars and 4 cents. However, this simple model has assumptions and limitations. First, it assumes constant dividend growth rate and stock yield, which would be extremely unlikely in real life. Also, it would be unrealistic to project in the far future because of uncertainties in economic condition and unexpected financial difficulties.
We obtained the data from this year's annual report. To evaluate the capital structure, we calculated the debt over equity ratio by dividing the total liabilities over total equity. So the ratio we got is about 0.0276 this year. We also found the DE ratio over the past 5 years for further comparison. So we can see that the DE ratio has been roughly the same at around 0.03 for the past 5 years, which could be considered as an extremely low number. This shows that the company's capital structure consists of almost only equity as its source of finance. Therefore, we reached to a conclusion that the company is adopting a prudent financial strategy, and that's the reason why it is so financially healthy and stable. It has a lot of cash in hand, especially when you can see that its current cash reserves exceeds far more than its total liability, which is around 181 million Hong Kong dollars against 126 million Hong Kong dollars. If taking into account of its bank balances, the number reaches a surprisingly high figure of around 778 million Hong Kong dollars. Its current liquidity ratio varied each year, but we can say that it has remained high enough for the past 10 years, and the figures seem to climb above 10 since 2015. It hasn't borrowed for 5 years, as illustrated by its zero gearing ratio, so it would be easy for the company to raise debt in the future in case of emergency or tough times for the business.
Speaking of suggestions, we recommend the company to increase the use of retained profits and finance more debts for property investment, which switches part of the capitals from warehousing due to the decline in industry demand. According to the company's annual report, obviously, debt finance is a cheaper way to finance part of the investment instead of cash reserves. Besides, debt financing reduces tax expenditures, consolidating the capital structure. The optimal level of debt is founded by plotting MC and MB graph of debt. Undoubtedly, such a high current ratio could prevent that increasing debts would lead to high risks. If our suggestions are adopted, on the one hand, shareholders' value is more likely to rise as the capital financed from debt is used to initiate new investment projects, potentially yielding higher return for investors. On the other hand, the stock market may be relatively sensitive to the new financing strategy, as higher debts may be risk-averse, and hence, investors may sell their shares, leading share prices to go down and followed in by lower shareholders' value, which is calculated by the amount of shares held multiplied by the share price. Overall, the shareholders' value is more likely to rise after launching the new finance strategy, as a huge proportion of the new capitals are prepared for property investment, which accounts for a substantial part of the total revenues.
Now I would like to explain our conclusion. First, we disagree with Resolution 5A. This is because the company's stock price is currently undervalued, and that means they currently would not be able to receive the fair amount of money through equity financing. We must keep in mind that when secondary stocks are issued, they are usually set at a lower price than the current stock price. Furthermore, there are chances of stock dilution. Second, we suggest that in order to improve the company's capital structure, they should not issue additional stocks, but finance through debt and their cash reserves. This would be a safer measure to increase investments, and we believe that the market would positively evaluate this, which would lead to the increase of shareholder value in the future.